To understand this concept of leverage, let's take a brief history of how forex was. Initially, in forex, it's not anyone that is allowed to trade forex. Forex was only traded by people we call the cabals, men of Wall Street, usually investment banks, rich men, monarchs, big businessmen, company owners. Now let me take New York Stock Exchange for example. For you to trade in the floor of New York Stock Exchange, you should be making a specific amount of millions of dollars per annum. You shouldn't be owing any mortgage. Your tax documents must be up to date, with so many useless criteria just to limit it to the elite. So also it was in forex then. Common men like you and me wouldn't have benefited from this lucrative business. Now, during the invent of the internet, the world became a global village. In that, you can buy and sell from anywhere around the world. This led to the proliferation of forex brokers. Now, forex brokers had so many customers around the world that they could solve that single problem of capital for us. Now, those world banks, etc., requires a certain amount of money for someone to be able to trade with. But because brokers have put many amounts of money together, we are now allowed to trade through our brokers. So instead of an individual trading with $1 million, you can actually place a trade with as little as $10 because you didn't go alone. You went to the market through your broker, who is recognized by the World Bank as a formidable force because it has a large capital base. I believe this simple illustration is understood. Now, your broker allows you to trade because he offers you what they call leverage in the forex market. The principle of leverage is virtually multiplying that your little capital so that you can use it and buy something worth a bigger value. For example, when you will fill out your forms for opening of trading accounts, you will see things like 1:500 or 1:1000 and etc. We also saw it when we were opening our demo account in some phones. Exactly. Now I will show you all where to adjust your lot size, which we talked about, depending on how much you want to be making. That is whether it will be $10 per pip or $1 per pip or $0.1, 0.1 cents per pip. In this image, the red arrow is pointing at the lot size that you have set, while you use the other purple arrow by this side to adjust the lot sizes to various lot size that you may want. That is whether to increase or decrease it to your desired lot sizes. That is what is making the profit we have in forex appreciable. Now we have come to the end of stage 2 and we will then commence stage 3. But before we begin stage 3, I just want to encourage you, if you are still struggling with what we have been doing so far, maybe you feel these calculations are becoming so difficult as if it's a Herculean task, continue revising all we have learned so far. You can start all over again from the beginning if need be, because different people have varied assimilation level. So you can always watch the lesson 2 or 3 times over again just to ensure that you are up to speed with what others are doing. Just tell yourself that so far others who you are even probably smarter than and who are even way more younger than you are doing it, that you can also do it.